Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 9th, 2017. I wanted to do a market wrap, a brief overview of the markets, where we're at, and then I'll do something a little bit different at the end. I'll touch on the main broad index ETFs, and then roll into the components of, or I should say, the ETFs that comprise all of the sectors within the S&P 500. I've done a lot of coverage on the Nasdaq 100 lately. I tell you that's the index I put the most of my efforts into tracking, but right behind that, and even more so important to the economy as a whole, is the S&P 500, since it contains more sectors. It's much more representative of the U.S. economy than is the tech-heavy Nasdaq 100, which lacks financial stocks and some other sectors. So let's dive into the charts, and we'll take a look at where we are. Starting out with the SPY, this is a daily chart. A little bit of a busy chart, but the most important readings or salient points here. This extreme overbought reading that we're coming off of on the daily, confirmed negative divergence. If you look at this purple line, this has really been one large rising wedge with the white lines. But from this point to this point, we have very clear and confirmed divergence, and that's pretty much across the board on all U.S. indices. So I'm just waiting to see this uptrend line crack. It's not the most significant uptrend line because we only have a couple reactions so far. However, it would just help solidify the case. We'll zoom down on each of these, take a look at the 60-minute charts. 60-minute chart, you can see the same stories, a series of divergences with this most recent divergent high here. We've now broken down this minor trend line. We broke that 236.98 support. Looked like we back tested it today and still closed below it. So the bearish case is certainly starting to shape up here. And for those of you out there that might think, if you've been bearish or if you're bullish and of the mindset these markets refuse to go down, make no mistake about it. All month since the beginning of March 1st, the markets have been in a extremely clear and unmistakable downtrend. A downtrend is simply defined as prices making a series of lower lows and lower highs. And this is March here. You can see the calendar down here. This is March 1st. So that's when the market's topped, and there's not an index out there that doesn't have a clear downtrend. Now, this is far from impulsive selling. I'll try to just cover these as I touch on these. This is a 10-minute time frame I'm at here. So top to bottom, we've only dropped about 2% so far, just a hair under 2% in the SPY. Let's take a look at some of the other ones. We'll move on quick. I've done extensive coverage on the QQQ, so I won't go into this too far. Here's the daily chart. Again, a series of divergent highs, corrections, and again, not one single divergent high is not played out for a tradable correction. By tradable, we're talking a few percentage points or more. And all those smaller divergent highs followed by corrections have just really been a culmination of one larger, more powerful divergent high. Most importantly, I was watching a couple things here, including a bearish crossover on the PPO, which we now clearly have. That has confirmed this large divergence on the daily chart. We had, as I mentioned, an overbought reading that we haven't even seen in at least a couple decades, if ever, on the daily chart. And I talked about I highlighted past market performance after such readings of 80 or more on the RSI. We've broken down below this minor uptrend line within the large wedge, fairly well defined, the white uptrend line. Certainly the selling has been anything but impulsive, but we are below that level, so that needs to put you on alert at least for maybe some more downside to come. Sometimes you break down and it takes a little while to play out. And it's possible, I'm open to all possibilities, that maybe we just correct in time, meaning move around sideways for a while, work off the overbought conditions, or burn off those divergences and then move on higher. So we'll see, but that's not my primary scenario. Far from it right now. So there it is on a 60-minute chart, pretty well defined uptrend line, rising wedge with a divergent high. You can see all the divergences marked down here, and I still maintain any of all these targets, most likely we're going back down to at least this 124.06 level, which would be a drop of roughly 5% or so. And now to go down to that 10-minute chart and just highlight again a little bit. The Qs are holding up, and I did a front page post on that today talking about market breadth, clearly, at least in my opinion, illustrating how it's just been a handful of names, these big beloved stocks, the Apples and Amazons and Googles or Alphabets of the world. That's what's been holding this market up. That's not uncommon. I've seen that many, many times in the past at key tops, even if it's not the top for the market, at least a top before a correction. But again, it is clear that we are in a downtrend with the Qs making a series of lower highs and lower lows. The only thing that might call that into question, and remember, the Qs or the NASDAQ 100 is just one index. So I use my analysis. I take all of these indices as a whole. But what would call this into question would be a move over this previous reaction high right here. So I don't look at each and every minor reaction. I look at the big reaction highs. What would be bearish would be, you can see these two previous reaction lows. So that's, in a very simplistic view. And again, take this in context with what the SPY and the Dow and the small caps and mid caps are doing. But that's what I want to watch for. And, maybe we continue to move down in a controlled manner for a while. Maybe we go sideways. Maybe we take out the downtrend lines. But you also need to be on the lookout for accelerated selling, because I've seen similar situations before. And by nearly every metric that I look at on the longer term time frames, intermediate time frames, it looks to me as if a decent correction is coming. So I'm on the lookout for any day now, to see the selling accelerate to the downside. Next up would be, let's go back to the daily time frame and go down. We're going down really in market cap order here, still on the large caps. Here's the Dow. I don't talk about the Dow often, but I did have a question brought up today in the trading room. And this is a clean chart, guys. This is as clean as it gets. I haven't marked every other past divergent, every other trend line. I could clearly show you all the trend line breaks, up and down trend line, bearish and bullish, patterns, and we had bullish divergences. But let's just focus on what is important right now, and that's this bearish rising wedge pattern. You can see the clear negative divergence down here on the PPO, on the RSI, making lower highs, curling over, the PPO making a bearish cross, confirming that divergent high at this point, and we're in a downtrend right now, a very near term. This is, there's different time frames, the intermediate and the longer term longer term trend, as well as the intermediate term trends, are clearly bullish on the markets. There's no two ways about that. But the very near term downtrend, which we'll look at here in a second, is certainly down right now. I haven't updated this 60-minute chart. I don't trade the Dow the Dow or the diamonds often. You can see there's an uptrend line. That's what I'd be looking at. There was a divergent high there as well. I could draw it out for you, but you can pretty much see the story's the same on just about all of these indices, so I won't spend too much time. And again, I don't trade the Dow. There was a gap to be backfilled, which now has been backfilled as of today. So bullish price action. If you're bullish and looking to buy a dip on a pullback, this is where the dip buyers should step in, and maybe it'll prove successful if they did, because that gap was backfilled on the Dow today. If we lose that gap now that it's been backfilled, in other words, we move below today's lows. This was an intraday pierce below the bottom of the gap, which would close back above. As I mentioned, 60-minute charts. I'm only concerned with what we get in the closing basis of a 60-minute candle, so that intraday break or intra 60-minute period break, prices managed to snap back up and close right on the bottom of that gap. You can see there. So that's technical analysis working for you so far. But we'll see what happens tomorrow. And then here's the Dow, looking again at that 10-minute chart that I've been zooming down to. Dow's down about 1.7% so far. And again, so this is what I call the near or short-term downtrend. Clearly bearish so far. And I don't see a lot. Well, this is a 10-minute chart. There's not going to be a lot to convince me to go long or short on a 10-minute chart. But I just trying to point out the trend has been down now across the board since the beginning of this month. Okay, moving down the spectrum as far as market capitalization goes, this is the Midcap ETF. Some of you do trade at MDY. At times I will, but So I figured it's worth covering, and the mid caps actually make up a very large portion of the stocks that are out there. You take a look at Google Spider's S&P Midcap Trust Series ETF or MDY and look at the holdings. You'll recognize so many of those companies as household names. So here's what I see on that. The chart shows a lot. You can pause this video and take a look at it. I show you divergent highs, divergent lows. Right here it's mostly a series of bearish rising wedge patterns, and if you look down here in divergent highs followed by corrections, it's to me very simple. I always say nothing is 100% in trading. I hate to come across as, I know some might been calling for a pullback for quite some time now, and to say that I'm frustrated is not really accurate word. I'm patient in trading. My convictions haven't changed, and I just want to say that if and when the charts change, I have no problem abandoning my expectation for major correction. But if you just look at history, look at these divergences, wasn't drawn here. You had a smaller divergence at this point, correction, a second consecutive divergent high correction. And these are all what I call tradable corrections. These lasted weeks, sometimes months, and you can see all the divergences. Now you see this is what I call clean divergence. I really like to see this was sort of flattening out here. It was still negative divergence because the PPO, the RSI, just about any indicator oscillator you put up there was making a lower high while prices were making higher highs, which is negative divergence. They played out for corrections. And we had a little downtrend line, that yellow downtrend line, it popped, and things changed. The presidential elections were a big shock to the markets. A lot of traders, investors, hedge funds, pension plans, they were all caught off guard, had to do some repositioning. So we had that Trump pump, which you're all acutely aware of by now, especially if you're watching this video. And here we are. We've come full circle, and this is about the cleanest divergence that I've seen, and this is a 2-year chart, even more clear than this divergence. This was a series of 2 divergent highs. And again, guys, I'm not expecting, we've already had a pullback. We're already down anywhere from I don't know, I think almost 2 to 5% on the major broad indices. And depending on which one you look at, I'm expecting a much deeper pullback here, and at minimum something along these lines on MDY. Let's see, from where we're at now, and we've already fallen. I'll get into that in a minute. I think we're going down to at least, I would say, right about here. I'm looking for about a 7% drop, again, at minimum in the mid caps right now. And let's just take a look, see if I have anything on the 60-minute chart. I have a little bit of a trend line. There it is. Sort of looks like a price channel. Divergent high. You can see the negative divergence just extended here. And that's pretty clear. There's a breakdown. And from the highs so far, mid caps have fallen. And there's a theme here. The reason I'm doing this is you go down in market capitalization. These are your more speculative companies. We started out with SPY, then QQQ, and DIA. Those are your mega cap, the largest companies in the world. And those are the few that I put, I made a case today in the video that those are the ones holding the market up. And as you noticed, they were only down a 1.5%, 2%. And as we go down the line here in market cap, now we're already at if you look to the box on the left-hand side there, the pop-up towards the bottom, it says 3.57%. And again, I'm just roughly grabbing the top here using that measuring tool. So that's a drop of, of about 3.6% there in the mid caps. Very clear, unmistakable downtrend. And that's the theme. Now, a couple more, and then we're finished, and I'll get into some of the components of the Dow, or I'll do that in a separate video. I'm watching the clock here on this one, try to keep it brief. IWM, busy chart. I might have had a cleaner board for you guys. I didn't. Yeah, there's one right here. Divergent high 2. This trend line I was watching, that's already broken down. Clear negative divergence. Just like we had negative divergence back here in a very sharp correction. This is where my money is personally right now, short, and the most number one is small caps. Secondly, QQQ. I think once they do break, you'll see a game of catch up to the downside. But you're seeing right now deterioration in the the smaller names in the market. Let's go ahead and look at the 60-minute charts of IWM, because I know a few others of you are trading IWM. There it is, divergent high most recently. and we've come in quite a bit. And you can see I talked about this. We had this breakout of this sideways trading range going back all the way to was that early December? Yeah, early December. We had this trading range there. Wrong tool. Let's try to click on the shadow box, show you the trading range. We did break out for a little while. As suspected, it was a failed breakout that was made on a divergent high. And as I often state, fewer things in trading are more bullish or bearish than a failed breakout, whether it's bullish or a bearish breakout. This was a bullish breakout, and it failed. You can see that is very impulsive price action coming back in already. We fell back down within the pattern, and my expectation is for more downside. There'll be bounces along the way, of course, but I think there's more downside to come. And just to try to quantify it, again, we're now on the small caps, so I grabbed the highs there from the March 1st, and you can see the small caps are now down about 4.2%. And finally, we'll wrap it up here, and then I'll do a separate video, real short one, on the components or the individual sectors within the S&P 500. I'll do that next. As we have, I rarely talk about it, but I sometimes trade it, the micro caps. And as the name implies, micro caps they're the smallest. There is another designation for stocks out there, nano caps, but the micro caps are at least some names that you'll hear. They're smaller than the small cap companies by definition. I forget the exact criteria. There's a certain so many 100 million, maybe 100 million to a billion, something like that. I forget what it is. You can look that up. And here's the story. Series again of rising wedges. There was a very powerful correction leading in up to the elections, and if I can grab right around the top of where the highs were before that correction started, that was a drop of almost 10%. Remember, when you go down in market cap, these companies, they can move a lot higher. They rallied more in the Trump pump than did the large cap stocks. They rallied 24%, which I know that was more than the SPY and the QQQ, but that cuts both ways. When they fall harder. So probably a lot of meat on this bone. Now, what I highlighted here was the 83.30 level. That's not a hard line. It's a rough number, but that's a pretty decent support shelf. So what's happened since the Trump pump, these small micro caps have run up, and they went in this bearish rising wedge. There was a divergent high. You can see negative divergence with a very steep divergent high. And they did correct from there, and they moved down, I don't know what it was, 5% or so, maybe more. But for the most part, because the broad market is being held up, most likely, all stocks tend to trade together. Some indices outperform others at times, but for the most part, they're going to take the lead of the large caps. And the large caps so far are holding up. But we are, as I said, seeing that continued deterioration in market breadth and the internals, the smaller companies doing much more poorly. And so we need to see a definitive breakout of the downside of this range. And I think that'll occur on a break below 83.30. But again, I never trade any one index or sector or security in a vacuum. I'd watch the broad markets, wait for confirmation on some of those key levels and sell signals that I was talking about earlier. All right, 60-minute chart. I don't have anything marked up here on this 60-minute chart, but I can show you on my theme of as you go down in size. Now this one's close. It's much more than the large caps. This one's down now about I didn't grab the very top. There it is. I got the top and the bottom of today's candle, 4.36%. And the downtrend is unmistakable. Of course, you can see I don't need to draw it out. You can see the downtrend there. All right, so that's the my view on the market. And like I said, watch these 60-minute charts. Not so much on IWC. I don't have a great chart marked up there, but things like the small caps, IWM, things like the SPY, where we broken below that purple uptrend line. We've given back that key support level. In other words, there was a big gap. This was a pretty significant gap here, and we backfilled that gap and then some. I pointed that out in the Dow that we backfilled and closed on it, but on the SPY, we've already given up that gap. That was a bearish technical event. The fact we tried to hold it. You can see the market fought real hard to hold that gap, but then has since moved below it. and each of these represent support levels to watch. And of course, there's the all-important QQQ. This one needs to die. Until this market rolls over, or until the Qs die, the market's not going to roll over. And so here we are in this tight little sideways trading range. We've broken below a pretty well-defined uptrend line. And so if you want to know what I'm watching for more than anything, is to start to see some impulsive selling and to move down below this range. And then I've already went over my targets many times before. All right, let's wrap this one up here, and I'll do a separate video which should be very quick. There's only, I think I'll have to look at my watch list. It's a little more than a half dozen different sectors that comprise the S&P 500, and I wanted to show you those each of those via their ETFs. So there's twofold. You can trade those, and I can point out the most bearish and bullish sectors. I can give you price targets, and I can also make a case, which I believe that the vast majority of those sectors confirm the bearish technicals that I'm seeing in the broad market. Okay, that'll be in the next video. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.